Earlier today, Muddy Waters Capital founder Carson Block joined Bloomberg Television, and he offered this pretty bullish advice on the Magnificent Seven. There's
a debate as to what really drives, when you talk about the U.S. market, especially the S&P 500 or the Mag 7. I'm in the camp that, although I don't have the facility with math to really try to prove this out, but I'm in the camp that believes that what drives that index are flows. And so at the end of every month, U.S. workers, a lot of them, their paychecks go into their 401ks, which are retirement funds, and there's a robo bid for these stocks. And what happens is you reduce the effective supply of stock because you're taking out the active owners of stocks that will decide, hey, at this price, I'm a seller, at a lower price, I'm a buyer. And you're replacing that with a holder that will never sell unless and until it has outflows because people are drawing down their retirement accounts. So according to that view, as long as the labor market is reasonably strong in the US, which it is, you're not going to see outflows. You're just going to continue to see inflows, especially in those, in the most heavily weighted names in the S&P 500. So I have, in the past few years, I have looked back on my career as an activist short seller and, kind of done the math and felt like, well, I probably could have just been levered long the S&P 500, deferred my taxes, and gone through a lot less BS, and be in more or less the same position financially. So, I mean, that does make the market more fragile, but there's a Fed put, there's always a Fed put. Does there come a point in time when the system breaks and the Fed can't fix it? Theoretically, yes. In our lifetimes, I don't know. So I think for now, it probably just pays not to think too much, just close your eyes and buy, probably Mag 7.
Muddy Waters Capital founder Carson Block there. Let's bring in another take. Seema Shah, Chief Global Strategist at Principal Asset Management. Are many that you're talking to feeling you should just close your eyes and buy back Mag 7 still here?
Well, hi, Caroline. I think there is that continued demand, certainly for Mag 7, and I agree with a lot with what was just said, in that the environment it's almost a sweet spot for US equities. You've got the Fed put, you've got generally a strong economy. There's a couple of risks out there, but they're actually more near-term risks, something that we wouldn't necessarily expect them to be have a sustained impact on the market. So from that perspective, yes, the US still looks really attractive. And the Mag 7, rather than just being a short-term play, I think a lot of people, including ourselves, are looking at that Mag 7 as something which is going to deliver not just for this year, but it's more of a strategic asset allocation play that we want to continue to have exposure to those. Having said that, in a positive environment for US equities with rates coming down and growth still fairly solid, you should see a broadening out. I think there's opportunities in other parts of the market which maybe are not as expensive, haven't really seen even some of that catch-up trade post-COVID. So I think there's opportunities everywhere, but certainly Mag 7 does deserve to continue to have that place in a portfolio.
Seema, Carson's core idea is that the market, particularly those Mag 7 stocks, will be supported because retirement money is kind of on autopilot, right? It just comes in, and that supports the index level. How does that impact your job if you're really genuinely interested in the technology sector as an investor?
So I think he's right in that there is always going to be that play of, that continued stream into the Mag 7. Remember also that the Mag 7, because of that cash levels, because they're considered a bit of a safety defensive play almost on the US economy and the US market, that it's almost some of that like a continuous stream of where some are considered it's going to be fairly consistent throughout. And to his point, until it isn't, it will continue to attract flows. So I think that does come into the thesis. And we have seen that play out over the last couple of years when things get a little bit tough. Mag 7 almost becomes that safety trade. So I think that still holds. It's just that there's probably going to be other opportunities that also retirement investors should probably be considering outside of just the Mag 7.
This week kind of starts earnings season in earnest for technology. How important is this quarter of all quarters, especially given that we have now seen the Fed move in reducing rates?
So I think, like every quarter is going to be more important than the last in terms of whether it's going to maintain the rally going forward. For tech, obviously, everyone is, the eyes on the tech sector are probably increasing with each earnings season because the expectations, in consideration of the fact that valuations are quite frothy, that there's always those eyes going to say, are they going to continue to deliver? Can they deliver on those very lofty expectations that investors have? So we do need to see that continued delivery. But actually, I still think that, look, let's say we were to get a disappointing quarter where you see a slight pullback in their performance relative to expectations. It doesn't necessarily sound the death knell. It's just probably a bit of a kind of a recalibration of expectations back to something which is a little bit more realistic. But then as we look at over a couple of quarters and years, I think investors will still believe that Mag 7, particularly with the AI narrative, have still got something to deliver.
I want to go exactly there, Seema, and we turn to our great control room to bring up what's happening with Nvidia, with the like of Palo Alto Networks as well. But more broadly, Nvidia, of course, the AI trade up to a new record high. It's seeing, though, other key cybersecurity names like Palo Alto Networks also on the higher side today and a new record high too. How important is the Nvidia, the chip sector, the AI trade to keep on leading these sorts of gains?
They are important. I do think they're reducing in importance, though, because of this fairly strong constructive economic backdrop that we have. But we do feel some continued enthusiasm about Nvidia and about AI generally, and other sectors, other companies that can continue to benefit from AI. I mean, you just have to look at chips and just say, look at the ones which are related to AI and the ones which are not AI related, and you can see there's quite a bifurcation coming through in the market. So there's a clear favorite with regards to that narrative, and investors are focusing on where can AI play a really strong part. There's the first generation like Nvidia, but what are the other next companies that could stand to benefit from this new theme that is playing out in the market?
Seema, we love talking to you because you can go cross-asset too. And David Costin and the team over at Goldman Sachs go cross-asset again today for us as well. Because on the flip side of what Carson Block is saying, they're saying actually, look, the S&P 500 cannot keep up the rate of returns that we're used to. In fact, we're only going to get an annualized 3% return in the future, for example, because they're going to go to bonds. We're going to go to other assets. Are you seeing investors wanting to go there out of equities?
So certainly from an asset allocation perspective, we do think that this is also the time to have exposure to fixed income. If you want to go safety, then you should be long duration. But to get that pickup in terms of yield, income, kind of play over the strength of the US economy, then credit is your place to be. So I think there's a lot of opportunities out there, specifically with regards to that 3% return going forward. I think that it is true that you're not likely to see the same kind of returns that we've enjoyed for the last 10, 15 years. A lot of that narrative was driven by the fact that the Fed and other central banks around the world had kept rates really, really low, which we're not anticipating going forward. We see rate cuts, but nothing returning to that incredibly easy monetary policy of zero balance sheet expansion. So it does mean that the maths is a little bit more onerous for equities, but it's still a compelling proposition. It's just that in this environment, there are opportunities across all of risk assets. And it makes sense for investors to have that diversification because it actually continues to deliver at this point.